Wall Street turns positive. Treasury yields fall further. This after the Federal Reserve decided that it will not, or says that it foresees no more interest rate hikes for this year. Now, joining me for some analysis on the Fed decision as well as the outlook for the markets is Terrence Gabriel. He is Stocks Buzz analyst at Thomson Reuters. Welcome, Terrence. So the Fed punts on the rate hike. That was expected. But now its policymakers are saying that are pausing on two fronts. No more rate hikes for this year, the way they foresee it, and also slowing its reduction of Treasury holdings and ending that by September. Were you surprised by that decision?
Well, I think the markets were hoping for that kind of action from the Fed. So the question is whether or not they had sort of perhaps built that in ahead of these announcements that we saw.
And were you surprised by the market's reaction? At first it was rather muted. Stocks didn't exactly skyrocket up on the news. Right now they've just turned positive, but for quite a while they were flat.
Yes, and in many ways I was surprised that it wasn't a stronger, more buoyant reaction to this kind of news. You might expect it would have been a sort of blast off. However, I mean, there was a rather substantial recovery off lows, but nevertheless, the major averages are only flat to slightly higher.
And why is that, do you think?
Well, there may be some concern, actually, that even though the Federal Reserve is sort of abandoning its projection for interest rate hikes this year, that they are also recognizing the slowing economic conditions that are out there. So that in itself becomes another issue that the market then has to potentially worry about here, which is what a slowing economy will mean for earnings moving forward.
And overall now, putting into context today's Fed rate decision, and right now Fed Chair Powell's speaking, so we don't know what he's saying just yet, but are you constructive on the markets going forward, or are you pretty cautious now given what it means for the economy and earnings?
I'm actually cautious when I look at, in sum, the potential for an economic slowdown to continue, which is, yes, keeping the Fed off the rate hike path, but at the same time is an indication that there are concerns about the economy and what that will mean for earnings. So therefore, as the S&P 500 has come back to within about 4% or so of its all-time high, it does remain to be seen whether you can sort of substantially trend higher from these levels, as well as we look at other technical indicators, sort of the condition of the market internally. We start to see some signs that are worrying us. For instance, the fact that, yes, the S&P and the NASDAQ have moved to multi-month highs, but for example, the Dow Jones Industrial Average and the Dow Jones Transports are actually struggling to move above their late February highs. So you're starting to see another sign of this sort of fractured market condition where the indices are not necessarily confirming each other. And that's something a lot of technical analysts look at and can become quite concerned about as what it means for the market moving forward.
Okay, fractured markets, we'll take a look and see if we get those signs of confirmation later. Thanks a lot, Terrence, for pointing those out. Our thanks to Terrence Gabriel, Stocks Buzz editor at Thomson Reuters. I'm Fred Katayama, and this is Reuters.